Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. This segment is brought to you by CommercialAgentSuccess.com for incredible video training for commercial real estate brokers. Check it out at CommercialAgentSuccess.com. Well, we have an incredible show for you again today. We're going to look at the National Association of Realtors Commercial Real Estate Outlook. And first we're going to talk about really kind of an economic overview, because as the economy goes, commercial real estate is obviously impacted. And then in the next segment, we'll talk about commercial real estate itself, both larger properties, and take a look at some of the small cap properties as well. Please welcome my guest. It's George Ratiu, and George is Director of Housing and Commercial Research with the National Association of Realtors, and he's joining us on Skype. George, thank you for being with us, sir.
Certainly, Michael. It's a great pleasure joining you today again.
Thank you. And as I mentioned, let's kind of look at the economy. It seems like it's had a kind of a slow growth, but is it a little more elevated now? What do you see for like GDP? It seems like we had a jump there, did we? And what do you expect moving forward?
Indeed. So we are basically in the ninth year of economic expansion. Believe it or not, I know that over the last few years, we've talked about the economy a little bit looking over, one shoulder to the last recession, wondering how is the economy doing? Are we really growing? So I think this year, of any of the last nine, we are quite solid in terms of economic performance. And if you look at the underlying reasons, we've had unprecedented monetary policy, which boosted a lot of this the last 9 years. Some of that now it's being cut back. The Fed obviously is beginning to raise interest rates, a little concerned about the pace of economic growth. But we also had a tax reform, which restructured corporate taxes at the beginning of this year. So that added a little fuel to the expansion. So GDP for this year started a little slowly, but by the second quarter, we were up 4.2%. So a very solid performance. And when we look at all components, we see consumer spending has been solid, again, boosted by employment, wages. We also saw business investments finally kick a little stronger into gear. We see spending on structures, very good for commercial real estate development pickup, equipment, industrial, and IT. So I would say on balance, GDP is poised, even with stock market volatility over the last week and a half or so, is poised to close the year on roughly 3% annual rate growth, which is a good, solid performance.
Okay, so you don't expect the over 4% again?
Not unless we have any upside surprises in the third and fourth quarter, but based on most indicators that are coming out, so third quarter will come out on Friday of this week around the 27th. So we'll find out what third quarter, at least the advance estimate is. But by most indications, I don't expect anything exceeding 3.5% for the third quarter.
Yeah, and you mentioned consumer confidence, which has been really high. And I think, when the stock market's doing well, when our home prices are doing well, as consumers, maybe we have more confidence. What do you expect moving forward there?
Well, consumer confidence, as you pointed out, has been strong and in fact accelerated over the last year as employment numbers and the momentum, more importantly, of hiring remained fairly solid. In addition, consumers have finally seen wage increases. With the unemployment down at 3.7%, employers are obviously facing a very tight labor market, so they have been increasing their compensation. Mid part of this year, we finally saw that compensation adjusted for inflation grow at 2.7% year over year, which is the strongest pace of growth in the last decade. So not surprisingly, consumer confidence has accelerated this year. And frankly, I expect it to continue doing so. I think that going into the fourth quarter, and what traditionally is the holiday season for retailers, this will be a very closely watched metric because a lot is riding, obviously, during this season on that confidence. But from most indicators of consumer spending and as I said, wages and other things, I think consumers remain upbeat about the economy.
Yeah, and you mentioned business investment has been strong. How strong is it? Do you expect it to continue to be strong? And is this a lot from small businesses mainly, or what do you see there?
So we're seeing investment actually grow for particular things like, for example, equipment. Investment in equipment was up by double digits. Investment in structures, traditionally commercial real estate buildings development, was also solid, and as well as intellectual property and R&D. So it's pretty much across the board. If you think about the fact that a lot of businesses depend either on their own funds for expanding their business or borrowing, they've done quite well. Corporate profits are close to historic highs. In addition, corporations are sitting on cash that basically is at record highs. So cash on corporate balance sheets is closing in on $3 trillion, which is incredible on one hand. It also tells me that a lot of businesses are still quite cautious about the economic performance, and probably more so the outlook over the next 2 years, given how much cash they have still on their balance sheets. But on overall, I would say between the cash availability and the credit, which has been quite available over the last few years, we're seeing that sort of investment across the board.
And George, what do you see for the impact of tariffs so far? Are you seeing maybe the economic indicators adjusting now because of these tariffs? Or maybe companies investing more, importing more? And what do you expect long term from tariffs?
Very good question. So from what we've seen so far, tariffs seem to have impacted the cost of doing business for several industries, particularly those that are reliant on steel, since steel comprised a big target for those tariffs. And we've seen that in the construction industry, particularly both, I would say, residential, but commercial as well, because of steel and lumber. Since Canada was impacted by them, we imported a lot of lumber. But we're also beginning to hear from other manufacturers like Ford, Caterpillar. Again, manufacturers that are heavily dependent on steel are saying that the high cost is beginning to impact their production. In turn, their own costs and likely are going to lead to a slowdown in possibly the pace of sales for some of these manufacturers. So obviously, in the long term, the tariffs are likely to have a negative impact in terms of economic growth, in part because while they will help in the short term domestic producers, absolutely, in the longer term, a lot of those costs cannot be absorbed by the manufacturers, so they'll have to be passed on to consumers and their own customers if they're businesses. So likely that is going to lead to a slight decline in demand.
Yeah, and I guess we can't talk about the economy without talking about housing and values of homes. We mentioned it, touched on it before, that so I guess when our homes are going up in value, maybe we have more confidence. Maybe we use our home as a piggy bank, and also just the velocity of home sales can really impact the economy. Is it really impacting the economy now, and what do you expect there?
Very good point. And in fact, what we're seeing there is a sort of a tale of two markets. And what I mean by that, folks who own their home and have owned their home for a while have seen, to your point, their equity rise significantly over the last 3 to 5 years. So obviously there was a big loss during the recession, undoubtedly, but during this recovery, values in aggregate of U.S. homes have exceeded the prior peak in 2007. So for those homeowners who have been owning their home, their equity is at record levels. So from that standpoint, I think that certainly adds to the level of consumer optimism we're seeing in the market. Conversely, for the other end of the market, meaning the buyers, these have been also unprecedented times in the sense that you look at the price appreciation for homes over the last 5 years, it has exceeded 40%. So we've seen 40% growth in price appreciation over 4 years. However, on the income side, wages have only grown over the same period by about 15%. So when you add that appreciation and you combine it with increasing mortgage rates, which now are roughly 5%, you see where for a lot of buyers the affordability situation has worsened. So we're seeing a decline in affordability. And moreover, what we're seeing is also a shortage of inventory. Buyer interest is still there. We're seeing buyers still come and look at properties, but sales have declined now for about 4 months, in part because buyers are hitting this wall of not enough homes. So even though they want to buy homes, when you don't have enough properties, it's hard to close a deal. So that, I think, is impacting the market right now. We are seeing a little bit of pressure on pricing as a result. As this situation with declining sales, we expect the prices to actually moderate. They're still growing, but at a slower rate. So it'll be interesting to see what the next few months have in store, in part because traditionally winter tends to be a slower time of the year. But as I mentioned, on balance, the market remains, I would say, fairly level.
Yeah, well, it's interesting. You talk about home values going up, interest rates rising, tariffs rising, increasing some cost of things. So what might we expect for inflation moving forward and then corresponding interest rate increases?
Absolutely. I think that inflation is going to move up. So it's already been rising this year strongly enough that the Federal Reserve is obviously taking notice and is moved to increase rates. And not only that, but as you notice, they're using their forward guidance, what they call forward guidance, to sort of telegraph their intent to markets going forward. And they've been quite clear about the fact that their view of the economy is positive enough that they expect to continue increasing the short-term rate. We expect likely the December meeting to come with another rate increase and possibly 3 additional ones into 2019. So my view on inflation is we're going to see it pick up, partly because the wage was the last piece. When you look at sort of the consumer price index, the underlying gauge of inflation, the housing component has been rising much stronger than 3% for quite a while, both in terms of owner's equivalent rent, which is what the government assigns for folks who live in their home but would otherwise pay rent. But as you know, on commercial real estate side, for the apartment rent growth has been quite solid over the last few years. So there have been a lot of upward pressures from housing. Now the wage has simply completed that picture. So we expect to see inflation move up quite a bit in the next 18 months.
So if you expect another increase in the Fed's rate this year and 3 more next year, then is your estimate of a total increase 100 basis points maybe in the next year? What would be your crystal ball there?
Well, considering the fact that the Fed has moved in quarter basis point increments, 25 basis points at a time, roughly, granted it's a range what they operate with, but it's been 25 basis point. So yeah, 4 increases would absolutely correlate with a 100 basis point rise in the short-term rate. So we'll see how that translates, obviously, to longer-term rates because they're not directly tied. However, longer-term rates, as we've seen, tend to follow shorter-term, as we've seen with mortgage rates. Even the 10-year Treasury, which for a lot of investors in commercial real estate is obviously a benchmark of the risk-free investment return, even that has moved up and has put a lot of pressure on, obviously, the spreads between 10-year Treasury and cap rates.
Yeah, and I want to talk to you about that and talk to you about commercial real estate in particular and some of the sectors and what do you expect moving forward there. We'll take a short break. Stay with us. I'm Michael Bull. We will be right back. You are listening or watching America's Commercial Real Estate Show.